Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Cory and Shad here, your hosts for this weekend show. Boy, oh boy, we're going to be talking a lot about precious metals, as we have been over the last few weeks and even few months. Now with the big question of correction, volatility, how to trade it, how to view it. No one has these answers, but all we can do is get some of our, I think even more so, our more generalist commentators to share how they're viewing the precious metals, because let's face it, a lot of new investors have come into the market, and now we need to figure out just their willingness to hold through some of this crazy volatility. Just as a note, please go through our website, podcast, YouTube channel. Just search The KE Report to listen to all our daily editorials covering these volatile markets and company updates from throughout the week. Still a lot of companies out there doing a lot of work that you need to be paying attention to. Let's get into this weekend show, kicking off the show with Mike Larson. Mike is the editor-in-chief at MoneyShow. Mike, we've been even talking a whole lot about precious metals because they've been coming up at some of the MoneyShow conferences this week, along with the tail end of last week. Big volatility in precious metals in terms of big down days and also some pretty big rebound days as well. But Mike, give us your thoughts on the volatility and the correction that a lot of people were calling for in precious metals this week.
Yeah, absolutely. I mean, holy cow. It's funny. I mean, you've been in this business for a long time. You know that precious metals volatility relative to equities is pretty, it's usually, nowhere near in terms of the intensity. You don't have precious metals, gold, and so on. I mean, silver sometimes can get really volatile, but you don't see gold tend to trade or fly around like an AI stock does. But, in the last several weeks, we've just seen, as gold had been ripping higher, silver had been surging higher, things like, I actually did a chart for a piece that compared the gold volatility index, GVZ, to the VIX, obviously the S&P volatility index. And it's crazy that the gold volatility index as of the other day, earlier this week, was up, 99% on the year or something, whereas the equity volatility index was up 2% year to date. That kind of gives you a window into the amount of volatility we saw introduced into the precious metals market. As a matter of fact, the gold volatility index tagged 33, which was the highest going all the way back to March of 22. So, as the run-up has increased, as the moves have gotten bigger, I mean, a $100 move in gold isn't what it used to be in terms of percentage terms, given that the price is a lot higher than it was a few years ago. But that's still a big number. And at one point, we had gold up like $175, and then, down 230 some odd dollars an ounce. I mean, those kinds of moves. And silver, I think, was down 9%, one of the worst moves since 2011 or something like that. So this kind of stuff going on is absolutely not normal, but, it's just one of those things that I think speaks to the kind of market that we're in, and I think also just the kind of environment where you get to the tail end of a move where everybody wants in, and that can just lead to just crazy action. So I think that's what you're seeing here. It kind of reminds me of just a more extreme version of what we saw back in March and April when the last leg of the move up in gold was happening. I mean, let's remember, it wasn't too long before, again, from a lower price level, that gold was surging back in March and April, and it looked like a big move at the time. Then we kind of had a blow off top and reversal. And what did gold do? It sat around doing nothing for months on end, but it didn't give back those gains. I say it sat around doing nothing, but it was basically consolidating the prior run-up. And then what happened in August, after that consolidation was over, bam, we took off again. So, I don't want to sit here and tell you that this is proof, this is the end of the run. I'm not going to sit here and tell you it's not something to be concerned about or at least pay attention to. It's a big enough move. It comes after a big enough move that, it would be only natural for this to lead to probably a long consolidation, maybe multi-week, if not multi-month. So I think that if you're trading it, as a long-term investor, I should say, I mean, is there much you do here? I don't think so. I don't think this is the end of the bull run in metals. If you're a trader, though, and you're looking to, profit on short-term pullbacks, you're probably going to see more of this. You probably see some weakness for a little while. And that would obviously apply not just to the metals themselves, but the equities that track them. So It does kind of smack as maybe a short to intermediate term top, even as, again, I don't think this is the end of the bull run.
Well, Mike, I'd be curious since you do talk to such a range of different types of investors at the Money Show, and you have kind of a generalist attraction because you cover so many different sectors at the show. A lot of them probably just got animated more recently with precious metals because it's in the headlines and they saw the price breakouts and they saw the stocks doing well. And, the first, second, and third quarter, it's been leading the charge as far as performance compared to a lot of other market sectors. What do you think the temperament is for those investors, those people that maybe just found the sector more recently? I guess maybe if they came from tech or from biotech or something else, the volatility may not scare them. For us as traditional precious metals, it's a little wild to see. But what do you think their temperament is as far as holding through the volatility or getting attracted to a different shiny object?
Look, you probably got pulled some weak hands in recently. I mean, I kind of joke in my presentation at the Orlando Money Show to kick things off last week. I had one slide about just kind of the fundamental factors I think aligned for gold, and why I still like the bull market. And then I put a slide up that had a screen grab from Good Morning America talking about why you should maybe invest in gold. They led with that story. I want to say it was a week and a half, 2 weeks ago. Now, when Good Morning America is covering a move in gold, I mean, that's not, that's one of those things that, like, again, it's not quantitative analysis at all. It's pure going kind of like feelings or sentiment or what anecdotal information, but that's not normal, right? So I think that, it's not surprising that we've seen after that kind of attention, and especially the sort of parabolic nature of the move more recently, that you're seeing the kind of reversal here. And, it's all about leverage, right? I mean, commodities markets, whether it's gold, whether it's silver, especially being kind of the junior metal to gold. I mean, you can get taken out in a box if you're not really careful in terms of what you're trading and how much leverage you're using and so on. So if you have some people that were coming in and maybe, trading this the way they would trade previously, extremely volatile assets, whether it's some of the junior cryptos or whether it's AI stocks or whatever, yeah, I mean, some of those people are probably getting smacked over the head here. So it's just one of those things where, again, if you're a longer term holder, you know, I don't say you ignore it, but you do say, I do think that it probably smacks of, again, more than just a 1 or 2 day thing. There's enough sort of volatility that's happened, two-way volatility, big moves, sentiment-based things and other things I've looked at that have just suggested this may, this is going to be something that has to be digested probably for a longer period of time than anything we've seen since April. So I would just, keep that in mind. Yeah, it's probably it's probably more than just something that's going to be over in a day or two and we'll be, at $5,000 next week or something like that.
This brings up, I think, a very important topic. Something that we did chat about during the week is that gold and silver were a momentum trade, and the stocks were a momentum trade that brings in a different type of investor. How quickly does momentum get lost? How quickly do those people bail? What do you how do you even analyze momentum now when you see this volatility that isn't to all-time highs day after day?
Listen, I think it's just something that you have to be very cognizant of as a trader, what you're, how you're trading this market, what kind of leverage you're using, what kind of stops you're using, how much, leeway you're going to give a position to move against you and so on. I think you have to, as it goes from being sort of a plodding, longer term, steady bull run to something that starts getting parabolic in nature, I think, yes, do have to sort of, put your trader hat on and start trading it like it's, some of this crazy moves you see in crypto or some, especially in silver. I mean, gold still, I think, is an asset that has a larger, stable ownership base, whether it's central banks, whether it's institutions and so on. So, that I think you're going to see more stability clearly in gold than something like silver, which can become a little bit more of a plaything towards the tail end of a move, which is obviously what we saw. But in either case, I think you definitely just have to approach this as, look, whatever I thought about this move, a month ago, 2 months ago, it did tend to get parabolic. It did have a couple of days of extreme volatility to the upside, downside, upside, downside again. And that's the kind of stuff that you see when you're probably at the end of a move for a short to intermediate term. So, it'd be great if this makes a liar out of me and gold's at $5,000 by mid-November, but I don't really see that happening. I think this is enough that it's going to probably be something that maybe we chop even through the end of the year, frankly.
I'm also curious, Mike, at your shows, the difference between, as you lined out, an investor and a trader. Because a lot of people say, oh, I'm a long-term investor in this sector, whatever sector it is. It could be tech, it could be precious metals. If we keep it to the precious metals discussion, they say they're long-term. then the first sign of weakness, they're like, hey, should I sell everything? So how do you deal with people that claim to be long-term investors and panic at the first sign of trouble?
I think you really gotta, be honest with yourself. If you're involved in this market, and like you said, I mean, we're talking in the context of precious metals, but it would apply the same if you were talking about other hot sectors of the market, which periodically have been everything from Mag 7 to AI to, Beanie Babies for that, for that matter. I think you have to be honest with yourself, right? Don't, if you were truly trading this market, don't all of a sudden say, "Oh, I'm a long-term investor now," as the position goes against you. Meaning, if you have high leverage, you're trading futures options, multi-X ETFs, long or short, and you get a move against you that when you start to see this kind of magnitude of movement, don't lie to yourself and say, don't let a trade turn into a long-term investment. On the flip side, if you're a long-term investor, you've made a lot. Maybe on a bounce, you start lightening up on even some of your long-term positions just a little bit, And again, it depends what your cost basis is. I mean, I'm lucky enough personally, and I think that, people who have followed what we've said on this show and what I've said on Money Shows, are have been in for a long time and have been sitting on huge profits. And I think, you don't want to just let it all go. I mean, if you get nervous by this kind of volatility and, you start finding yourself checking your phone or whatever from dinner and stuff, then you have to ask yourself, do I really have sort of the steely-eyed nerve to ride out this volatility, or would I feel better if I sold, I don't know, 5% of my holdings or 10%, just whatever I need to find peace of mind? If you're a long-term investor and you're now starting to behave like a trader, just like if you're a trader and now you're saying you're going to be a long-term investor, those are warning flags in either way. So just make sure you understand what kind of buyer you are, what kind of owner or holder you are, and be honest with yourself and make adjustments that, allow you to continue on and participate.
Yeah, have a plan. Too many people don't have a plan, but as you said, don't change your narrative either. I love that. If you're a trader, don't say you're long term because it went against you. Get out and make a different trade. Now, one other thing I just want to ask, is it ironic in your eye here, Mike, that silver, when it finally broke over $50 that everyone was waiting for, as gold just kept hitting new all-time highs, is it ironic that now is when we start to see this correction?
It'll be interesting. You can only kind of look at maybe the longer term implication in hindsight here. I think that again, as long as I'm not over leveraged, which I'm not, but I mean, as long as meaning a listener out there, is not over leveraged, you get this kind of pullback and you get smacked and you break that $50 to the downside. Now you see, as you pull back to various moving averages, which have, obviously gotten steeper over time, as you pull back to different levels, see how it behaves at those levels. If it just knifes through it like like it's not even, there's no support, then that's a little more worrisome versus if, even at short and then slightly longer term support levels, we base. So I think that's going to say a lot. I mean, it's hard to be patient. I get it. You see a 9% decline in silver futures and you're like, oh my God, running around with my hair on fire. But I think if you can be a little patient, if you're in the right kind of investments, again, when it comes to leverage and all that stuff, you can be a little more patient with it, give this pullback a little bit of time and see how does silver behave at 48, 49, 47 as it kind of pulls back. Longer term moving averages are all the way down in kind of the mid 40s. So, and I should say short to intermediate term moving averages are down there. That's a sizable percentage move. But again, when you think about an asset that was up, 90% year to date or something, I mean, it's not quite as big a move when you look at it in that context. So just, again, my best advice is just be cognizant of what your goal was going into this market and make sure your actions are consistent with your goal and your holding periods and your leverage and everything else.
Well, Mike, I think another interesting topic is when you go into a trade in any sector, again, we'll keep it to the precious metals. The point of it is to make money. You're an investor. So whether that's long term or short term, you want to make more than you put in. You don't want to lose money. But the other thing is you need to have an exit strategy for eventually when you ring the register. When you see a cycle where it played out textbook, producers ran, then the mid-tiers, then the developers, then eventually the juniors, gold ran first, then silver. You see the junior ETFs taking over the senior ETFs. When all of those things have played out, and it seems like later cycle, at what point is the ride over? And I'm not saying the precious metals ride is over, but I'm saying when you're placing a trade, is it something where you get out in stages personally, or when you talk to people, or is it something where you just say, hey, I'm ringing the register, the trade has played out better than I hoped for, and I'm moving on to another sector? How do you look at those parts of it, the exit strategy?
Sure. I mean, I think from a longer term perspective, I mean, kind of me personally, I just sort of, and what I advise is just see how things behave on a pullback. See how after this happens, after some of the dust settles of the day-to-day volatility, are you finding support at these levels? Is it kind of like April where we pull back, but we don't give up too much percentage-wise from the gain? We find support and then we sort of chop in a sideways pattern. That would be ultimately the best outcome if you're still a long-term bull. If I see things just fall, not, clipping through support and, giving back 10%, 15% turns into maybe 20%, then you got to start asking, is this something that's going to last even longer? I mean, I don't, the short answer is you don't know until you know. And I think as long as you're in the right instruments, and if you're a long-term bull, you can be patient and see what happens. I think one of the things I'll be watching is the dollar, is how other assets behave here, is what happens with interest rates and so on, to see if some of the other long-term forces that have been underlying this move for months and months on end start to change. I don't really see that. I see more of just, momentum ran out, and just like with any high momentum move that's way out over its skis, this is what happens. But if we start seeing other things fall into place, the fiscal government gets some discipline, interest rates start, going up versus down, the dollar really starts stabilizing and turning higher and taking out overhead resistance on the DXY, things like that, then that would where it'd be like, okay, this is something that's going to be multi-month, maybe even multi-quarter. So you're going to take 30% of your gold holdings off the table instead of maybe 5% just to make yourself sleep better at night. That's sort of how I'd look at it. I mean, again, I don't have the answer. We don't have the answer. Nobody listening to this has the answer, but I think you kind of have to give it a little bit of time just to see how it unfolds.
That is such a good comment, Mike. And again, it's why I said on the intro, no one knows where this is going. But as you just said, we can look at some other potentially correlated markets and maybe get a feel for if something truly longer term has changed. It's also just interesting to see this volatility really without any significant news, or I don't think significant news that really caused this sell off or trade. But there was another momentum market in the minerals and metals with the critical minerals. That was a little bit more news based with how much the US government was investing in companies. And also this week, the news that the US and Australia have come to some sort of an agreement for critical minerals supply. This definitely doesn't take China out of the equation since they are such a huge player in critical minerals. But the critical minerals stocks, they went almost tenfold in a matter of a month, and now they're correcting. Have you guys been talking much about critical minerals at the money shows?
Yeah, it's interesting. Just as you're talking, I'm pulling up my charts like U.S. antimony and so on, and MP materials, some of those names you're talking about. I mean, yeah, let's be honest. People have been looking for other ways to, other parts of the metals market to get involved in, other things where sort of Team USA is at your back, and some of the things that have been, going on there in terms of, investing, locking arms with the government to invest. It sounds kind of weird to say that as a bullish thing, but he's got Uncle Sam has pretty deep pockets, so if he's buying something, then maybe it's something I want to get involved with as well, regardless of the longer term kind of, I don't know, whatever you want to call it as a result of that. But yeah, I think people are talking about it. People are looking at it. People know that the U.S. wants to sort of try and position itself in a better place on the global stage vis-a-vis China and so on. So, but again, all I will say is like again, as I'm looking at the chart. United States antimony was trading at, let's see, about $5 in mid-September. It surged to, what do we got? 19 and a half bucks just the other day, October 14th. Now it's at, 11 and change. Or when I say now, I mean, as I'm looking at it on my screen, those kinds of things, be honest with yourself. If you're trading this stuff, understand you may be I mean, if you're trading it actively, you're looking to run up on a momentum thing, there's been enough of a move that this is probably going to be dead money for a while, maybe. I mean, like a chart like that longer term sure looks like it's one of those things that had a big blow off move, and now it's gonna, need a long time to digest that. And that's just picking on one stock, but I think if I looked at almost anything in the sector, it would be relatively similar. So just understand what you're buying, what you own, what you got into it for in the first place, and if you got into it for a hot trade to ride the momentum, guess what? You want to get out of it because it's probably losing that momentum. If you bought this as a long-term hold, you can handle the kind of volatility that comes with it, then you're not going to want to freak out over a move like this. You probably just say, I mean, if you bought some at 5 and you're at $11 still. Lighten up if it makes you feel better. I mean, it's still more than a double. So don't be crazy greedy. Do the smart things you would do, whether it was U.S. antimony or some internet stock in the late 1980s or 90s. I mean, make sure you're just honest with yourself. Do the right thing as a trader or investor based on what you went into the trade or investment for in the first place.
Well, Mike, just to follow up on the critical minerals, one of the things that's interesting is how much news it's getting from this administration, whether it be in the big beautiful bill, some of the parts designated for critical minerals, or in the Biden administration with the Inflation Reduction Act. There was a lot of stuff in there about critical minerals, but you're also seeing executive orders. And this whole thing makes me think about what happened with uranium and nuclear stocks when DeepSeek came out, torpedoed the sector. AI stocks are down, energy stocks are down, but then the Trump administration comes out with 4 executive orders, uranium stocks, nuclear stocks shoot back up. That's what's been happening with rare earths. That's what's been happening with antimony. That's what's been happening with tungsten and all these critical minerals. Do you think it's something where the news flow from the administration could bail out even pullbacks, even in a volatile market?
We'd have to see what the magnitude of the news is. I mean, let's be honest, in the Trump administration, there's tape bombs that come up. I mean, that's the term. You've probably heard it before. I mean, you can look back at what happened with copper, with the whole futures market there on the tariff, no tariff move, huge move up, then big, give up of those. But all right, you mentioned uranium, so I just threw up Cameco on my screen. Now here's an interesting chart, right? Cameco went from what, down in the 30s back in April, ran all the way up the other day to almost $100, pulled back to almost $80, and now it's trying to base at a previous level of support. It broke out, pulled back to support. It'll be interesting to see kind of how it behaves here. This would be a prime example. Actually, this is a great chart that I put on there just to kind of get a sense for how do these, that's obviously Cameco is not one of these little tiny junior miners, explorers, what have you. It's one of the big behemoths in the sector that represents sort of the benchmark for uranium. So how does it behave here? Same thing I would say if you looked at some of the, the big gold stocks or the big copper stocks and so on. Look at how the megas are handling this thing. Newmont pulling back to support. How does it handle this first real test of the strength of the uptrend? That's what I'd kind of be looking at, because if you see these names do what they did in April, which is after the big run up, chop sideways in sort of a bull flag type pattern for several weeks, and then find a base, and that base allows them to turn back up again, great. Then, we're fine. If this stuff just sort of all falls out of bed, all I can do is counsel patience, because, if you're a long-term holder in this, you don't have the answer. I don't have the answer. Nobody listening to this has the answer. But the behavior on the pullback will tell you a lot, and I think that's true for some of the mega companies in the sector, and that's probably where I'd keep my eyes on.
Mike, we're going to wrap it up here. We're out of time for the weekend show, or at least the first 2 segments. But boy, oh boy, I think this is probably the most insightful comments we've gotten all week on this volatility and pullback and how to trade these markets and what to look for in these markets. Because you're right, no one knows where this is going. We can all have kind of our longer term thesis, but we do need to sometimes change that thesis if needed, but not on the back of just a couple trading days or even 1 week of trading. This is going to take time to figure out what this top looks like, if it's short term, if it's long term, or if it truly is a top or just a trading opportunity. But many things that you've given us that we should look for. So thank you very much for that. Again, Mike Larson, editor-in-chief at MoneyShow. Mike, thanks for your time on this weekend show. And everyone, stick around. We're going to be right back, continuing to get some comments on how to trade these markets.
Thanks for having me. Take care, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. We are now chatting with Rick Bensignor. Rick is the president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail and individual side, Check out the In the No Trader website. I'll post the link in the show notes on our website, podcast, and YouTube channel. Rick has two products there for the individual trader, a weekly report called the Tactical Trader and a daily report called the Daily Tip Sheet, all of which trying to help navigate what these markets are doing in really a generalist sense. Rick doesn't care what he's trading, just wants to be trading markets that are heading higher and avoiding the ones that are not showing that strength. Rick, I do want to start off with the precious metals correction. Gold and silver have seen a lot of volatility over the last week and one trading day, all starting 2 Fridays ago. This correction very much called for. Everybody, even the gold bugs, were thinking that a correction was due because of the really euphoric run that we saw in the metals prices and the underlying equities. Now that the correction is here, Rick, as a trader, what do we look for? How do we view and how do we understand what these prices are going through?
So these things have run up so much that actually, if you look at things, let's say in GDX terms, so gold miners terms, and using that as the benchmark for gold miners, the high was precisely what had been the height of a trend channel that it had traded in for quite some time that broke out to the upside. And if you added the height of the trend channel to itself, it's so one way of measuring where an upside target is precisely where GDX topped. So the pullback from it happening, what was it, last week was the big down day, was not a surprise to see. But I can tell you that I bought silver, palladium, and only because I already have a decent position in gold, I didn't buy more gold. But the same models that got me to buy silver and palladium on the lowest low of that pullback showed up in gold one day later. So I have added exposure on the pullback. I especially like silver long term. I know that once again, we kind of topped out similar to prior highs, but I think it's only a matter of time before silver plays more significant catch up to gold and is also be favored by retail oriented clients because the price is in their heads more affordable. So I think silver, even in the mid to upper 40s, has $60 to $70 silver looking at it down the road. And so on a percentage basis, I still think it's got more to go. No surprise, though, that in and around $50 silver, we got to a little higher in futures, but SLV barely made, I think, a new all-time high. Maybe didn't even do it. I don't have the chart up in front of me, but pullback. Yeah, so it made by one day, it made a slight new high and it's pulled back. And so I'm a happy buyer down here in SLV and the 44 handle. And I think it's going up. Now, given how price topped and where it topped, I don't think gold just instantly comes back. And it's been kind of tagging along similarly to the S&P in price performance over the years. But I think now you kind of have a top in place where what I'm buying now, I may take some profits on, 10% higher or something like that. And then ultimately play for a breakout to new highs. But that could be down the road. I don't think it's coming immediately.
Well, Rick, just to follow up on silver, it did break out to new highs compared to the 45-year neckline that it had from 1980 to 2011. So it did get up to $53, $54 on the futures and on the spot. And we get a lot of questions because it's been in backwardation. We're actually, the spot price was between $1 to $3 more than the futures price, a little unusual. And I know you spent so much time as a commodities trader. We get a lot of questions about this, like, what does this mean? People are saying it's a shortage of physical, which I don't know where you fall in that camp, but what do you think about a market that takes 45 years to finally break out to new high, even if it's not as pronounced on the SLV? It was in the spot price and it was in the futures price.
So it's a couple of things. As a long-term investment, it's crappy compared to having put, let's say, money in the stock market. Gold is a different story, but silver, the fact that it took until now to take out the 2011 high and the 1980 high just says to you as a long-term investment, it's not great. And it's certainly not. Now, I bought silver in 2011, bought SLV, so I think we got also close to $50 an ounce in 2011. And I bought it too soon. I think I bought it I know I'm long SLV from the low 20s. So I bought it too soon because it went well beneath there. And it's just something I held on to. And now I finally have doubled my money. Doubling my money over 14 years is not a great investment. So the answer is you own this as partially as a hedge, partially because you just like the shininess of looking at some silver, but it's not a great long-term investment. Gold has been a far superior long-term investment. There's multiple reasons which for that being the case, and I'm not going to get into it just because it's more of a lengthy discussion. And those of your guests who are more, fundamentally oriented can explain more deeply why silver has been capped so much more so than gold. But I think it's that this pullback is a viable pullback. And even if it fell another 10% from here, now we get down to, $40 silver, which is a little more in SLV terms, which is a little more than a 20% pullback, which people say, oh, bear market. I think you want to own this over time as part of your hedge, whether you think of it in the alternative asset space where you own some metals, you own some crypto. I was looking at and trying to guesstimate where the price of gold is going over time. I haven't done it for silver, but I did it for gold recently. And I really had to be kind of creative because any of the targets I've had have already been surpassed. So I had to look at different ways of trying to figure out the momentum and the thrust and where gold can project to over time. And it sounds insane, and it may very well be. And there's no time frame on this call, so it's not like I'm putting this call out to clients and saying buy it because this is where we're going. Because I don't know. I'm in my 60s. I don't know if I'll be alive when it gets to where I think I'm going. But I came up with a number, and I don't have it in front of me, so I don't remember the exact thing. But I know it was somewhere in the $8,000 range per ounce. Again, to me, insane. I used to trade on the floor of Comex when the thing was trading a couple $100. To think that, this is what I'm potentially projecting for the price of gold over time is hard to fathom. But in trying to come up with some reason of why to be a longer term holder, and despite how much it's moved up, how much it still may go, it still could be, a doubling of where it is now. So to me, that means you buy pullbacks and you buy and hold. So you're not going to, if gold pulls off $100, that doesn't necessarily mean it's a buy. But if you've got good tools like I have, because I do much more, let's call it deep technical work than your average technician with models that they don't even have their hands on, and much more institutionally based type of models, not generally available in the public, then there are ways in places that I can identify potential turns and targets. And to me, I will be buying these on pullbacks for whether it ends up going to my kids down the road or I'm alive to see it, but eventually still well higher prices for metals.
Yeah, that is a much higher target and still sounding like you're playing this very much like a bull market here. Fair enough. Look, it has been a flying bull market now with a little correction. Rick, just want one more question on silver. And we've had some people come on the show. And yes, while silver has broken out from just a simple chart, looking at any price chart, some people are saying the inflation adjusted price of silver is $100 to $200, and that's where silver needs to go. Should we be paying at all attention to what an inflation adjusted price would be for any commodity, let alone silver?
Well, I think you can as part of your overall analysis. I wouldn't exclusively look at it and say this is the only way to properly measure it, because most investors and traders, and well, let's stick in the investor category, forget about traders who are in and out. Most investors aren't looking at it in those terms, and their buy and sell decisions are not based upon adjusting their chart versus the CPI or whatever inflation adjustment you're going to use over time. But in your grand analysis, to disregard that, I think, is missing a piece of the puzzle that should be there as part of how you analyze. So, yes, I think you need to consider on an inflation adjusted basis, where is silver now? Where is it relative to where it's been in the past? And how much more might it go down the road? So the answer is yes, you need to look at it, but not exclusively look at it that way.
Well, Rick, if we just zoom in on the gold and silver equities real quick, you kind of mentioned what was happening with GDX and SIL, and I know you look at the ETFs. The earnings season's upon us for Q3, and the average price of gold, at least according to Newmont's yesterday, where they kind of kicked things off after the market, was around 35 and some change to like 35.30, 35.40. The average silver price for the third quarter was around $38. Well, now we're $10 higher than that in silver, and we're a couple $100 higher than that in Q4 as we've kicked off October. Now we're still only about a third of the way through this quarter, but when you look at earnings reports, obviously a lot of people focus on forward guidance, what it's going to look like, but thus far it looks like we're going to have a lot higher prices. Do you think those kind of things are already factored in at this point when we're still getting Q3 numbers, or do you think there's the potential for that to be a catalyst where people say, holy cow, these companies are really doing well with revenues. Maybe it's going to be even better for October. Do you look at those kind of factors when you're doing the fundamental analysis?
Yeah, I think in general, fundamental analysts on the street tend to be behind the times and have a historical reputation of upgrading late things that they've missed out on, and often telling people after the fact of what targets are going to be. And sometimes their targets are consistently lower than where something's trading, but they keep moving it up as they're proven wrong. But they won't, if they had a silver target, let's just call it $45 an ounce, and we got to what, 53 or something in front month. And, now they'll say, all right, going out 12 months, we'll raise it to 50, but they'll probably raise it to 50 when silver's trading 55 or 60. My years on the street, I just think so many analysts are behind, especially in stuff that's not been favored. The public more and more is waking up to alternative assets. Some have never owned precious metals as part of their portfolio. Certainly, many have never owned crypto. And I think you look at these markets and what they potentially could be if you start getting the big brokerage firms saying, yes, you should put X percent of your portfolio in them. And traditionally, many of them said have 3% in metals. Well, what happens if they say, you know what, put 6% in metals and alternatives? How much more inflows that can create for these markets? I also think the white precious metals like platinum, palladium are undervalued. I bought some PALL, the palladium ETF recently. I got clients in just a few weeks ago. I think we got in at 116, something like that, got into the 140s. And I just bought the pullback, this week on the low of the move. I think those metals are undervalued. If the shift from electric vehicles continues and you get more hybrids being built, and still to some degree a strong focus on traditional catalytic converter type engines, that's good for platinum and palladium. They had really taken a hit as the whole electric vehicle era came in, and now you see more and more companies kind of backing away from that. So I think those metals, I own palladium, and I think it's got a decent run. Don't forget, I don't know, I'm just guessing here, I can't quite remember what it was, but 20 years ago, Palladium was the most precious of the precious metals. And then it got killed along with platinum, and obviously not down at the price of silver. But you look at where gold is, and you look at where platinum and palladium are, and how much they could potentially play some catch up in a scarcity of those metals and increased demand. I think, at this point, do they have a better chance of doubling compared to gold doubling at this point? Probably.
Rick, you mentioned something there that I want to dive a little bit more into, and that's retail investors seeming to have a bit more influence in these markets. We were reading about it really through this year, maybe even into last year, about how retail investors were buying the broad averages, buying the Mag 7 and pushing those markets higher. It really does seem like we got some retail investors that came into the precious metals during this almost parabolic move higher. What is the change that I guess longer term investors need to understand, that retail investors have a bit more influence? And how do we see that show up either on the charts or in individual equities if we are focusing on precious metals, to know and understand that retail investors still are on side for this trade?
I think it's a combination of several things. There's no one easy way to see what retail is doing. You do get some sense, Schwab often announces it, Bank of America announces it, what's going on the Merrill side. So sometimes you get a sense of what those flows are on the retail side. And that's helpful just in getting a sense of the flows coming from that direction. But yes, you can often see it in the charts, the way things trade, how things trade relative to VWAP, which traditionally was a much more institutional way. And now that VWAP is available to the public through many platforms, I think they're taking some of that edge away from what institutions used to have. And one of the biggest things that was clear this year, and more so than we've seen in a long time, is the influence of retail and their belief that equities were going higher, to the tune that they were buyers on the way down in the decline that we saw from the February high into the April 7th low, whereas institutions had sold and profitably sold. But then institutions were much more apt to fight the rally that has taken the market well beyond what were the, in SPDR terms, 613 high from February down to the 482 low on April 7th. And now you're talking about something on all-time high up in the 670s, whereas institutions are lagging this year, and many hedge funds are not close to performance of even what the SPY is. So although they looked like they were accurate and doing what people paid them to do the early part of the year, you would have actually been better off holding SPDRs than having a hedge fund trade for you for many of them. Certainly some have outperformed, but there are a ton of funds this year that have not, especially in the multi-pod type firms that sometimes have dozens, if not 100 or more portfolio managers who trade all across different asset classes and stuff. Those are tending to lag because so many of them fought the idea that this market could actually rally. And you know what? Once we're saying this, let me just switch the conversation for a second from metals to the stock market. So today, SPY's, Qs, diamonds making new all-time highs, and the diamonds have finally hit the target level that I put out in the spring when I suggested that when diamonds get to a level that they hit today, we are likely going to be at a trading top that few will see or be prepared for. So as the headlines are going to come out of today, an expiration Friday for options, and the market flying to new high, and the S&P up over 60 points, and we're only halfway through the day. I'm actually selling some of my stock indexes right now that I've owned, through ETFs, because without going into all the details, the same model that in July of 2024, identified where the Qs were going to stop, which they did in July, and then fell 15% in the next month before turning around and going higher. When obviously, if the Qs fell 15%, all the other stock indexes fell too. Maybe not as much, but they all fell to the 609 spider target that I first started talking about in August of 2024 as when and if the market gets to, you want to materially reduce your holdings for a also double-digit percentage decline. And we hit 609 on December 6th last year. We went sideways for 2 months, printed a high at 613 in February, which was 2/3 of 1% above the target I had put out months before. And then we fell 20% in SPYs and Qs into the April low. And then in the back part of April, I said when the diamonds hit a particular level, which they hit today, we again will likely top. And so I am one of the few probably standing here today saying that I think in the next couple of weeks, we're going to see a 5 to 8% decline across the stock indexes. And that may be not enough for, people to sell out, but I think it's going to be, kind of come out of left field, and you're going to hear it. I'm saying this on a day that if you turn on business television, you're going to hear about how beautiful and wonderful the market is, closing on all-time highs. And I think right here and right now, we are actually at a very precarious place in the market.
Well, Rick, it's an interesting point of view to have just because so many people are overly bullish today on financial media, as you point out. Now, you can understand where people are coming from when they see a market making a new all-time high on the daily and the weekly, to close up a week. And it's looking like it's pretty close to doing that on a monthly, too. So when you look at a market, any market that's breaking out to all-time highs, daily, weekly, monthly, but then counterbalance that across the targets you were just laying out and why there's the potential for a pullback. I mean, help people make sense of that, because most people would think, wow, ending the week on a high note is a high note.
And it is. It is. There's absolutely nothing that you're going to see or find that would suggest anything other than what you're saying. It's a high note. It's all-time highs. Daily chart, weekly chart, monthly chart, everything, right? All all-time highs. You're also at a precarious point from a risk-reward point of view to first put on longs at Spider 678. Could we go another percent or two? Yes. Do I think we're just going to fly without some pullback first? No, I don't. Even to a simple, if you look at the COVID low, so here, listeners, do this as I'm telling you. Go pull up a chart of spiders and use the function on your charting package that lets you draw a channel. And if you draw your first 2 points as the secular low from the COVID low in 2020, and you connect it to the July 2022 low, the next major low, and then take the highest point in between those 2 points, which is the probably fall. I can even tell you it is the, what month is this? It is the December 21 high. We are right up against the top of that channel. We're actually slightly above it, but that means also from a risk reward point of view, to get long at the top of a channel and not halfway down into it or the lower end of it, which you could have done on the April low this year. The risk here of first putting on new longs is substantial relative to you making money. So where's the next 3 to 5% if you buy something now? Probably down, not up. And I'm not generally game on buying at the top of a channel. I try to buy weakness, not strength. And there are times buying strength works, but right now, right here, not for me.
So, Rick, what's happening in these markets then if we are going to see a general slowdown? We all know that these markets have been pretty strong. Is money flowing back into potentially even bonds as we've seen yields turn down a little bit? Maybe investors are taking, at the end of the year, a more cautious, less risk-on approach?
So here's what I'm thinking: we get a quick sell-off that will coordinate both with the Fed lowering. Look, right now, Fed fund futures players have a 99% chance that Jay Powell is going to cut by 25 basis points next Wednesday. 99% chance, right? So it is completely beyond consensus that he's cutting this coming week. You also have election day a few days later. I think that it's possible that becomes the catalyst for a quick decline. Again, 5, 8%, maybe double digits, but I don't think much more than that. And then a turnaround higher again. So, for tactical traders, you're not a buyer up here. For investors, if a 5 to 8% decline, and again, I'm guessing it's a minimum 5% decline across the three major U.S. stock indexes, which are S&P, NASDAQ 100, and the Dow. If 5 to 8% doesn't scare you, then you don't do anything. You don't sell out of anything. You just wait. And then here's the thing that I think is why there's the potentiality for a rally into year end in the early part of next year. There are, if I remember correctly, I might be off here on the number, something like $7 trillion in money market funds. And as the Fed lowers rates and the rates of money market funds kind of similarly drop, there's a point to where people might say it's not worth getting the few percent of interest. I might as well go and put it into something that, I'm taking some risk, but has a much better chance for return. So if money market holdings fall from 7 trillion to 5 trillion and 2 trillion comes out, some will go into bonds, probably more on the corporate side than the treasury side, because I don't know, unless you're an insurance company or a pension fund, I don't know anybody who's going to want to lock in, will at that point probably be something around 3.75% for 10 years. Most people in the public aren't looking to do that, and you get stock market that flies like it does. So you may get trillions coming into more risky assets, which will drive things higher. So potentially that's good for crypto, metal, everything that you call a risk asset. So that's why down the road here, I think there's more coming to the upside. And as a second part of that thought process, I don't think everyone's fully in on the AI trade. So even though people are talking about a bubble, I don't think that bubble is ready to burst yet. It may lose a little of its, the balloon may lose a little of its air if I'm right about this impending quick sell-off. And then, it could be similar to what you just saw in the metals, where you just out of nowhere, the day before gold sold off a few $100s, it had closed on the all-time high at the high of the day. There was just nothing to say it was coming. And I think that's the type thing that's going to happen with stocks. It's not going to be a crash, and it's probably not going to come in one day. But in a string of a few days, you may get several, and in chart terms, candles in a row that you open near the high and close near the low, and then you gap lower and do it again. So I think there is something like that likely coming over the next couple of weeks, especially given that today hit the target I was talking about. And, even since we just started talking a few minutes ago, the spiders are off 3 points, which is, S&P is off 30 points off its high. So we're still closer to the high of the day than we are to the low. We're 2/3 of the range off the low, but it's already corrected a bit as we're talking. And I think that people need to be aware of this as far as taking advantage of this impending decline, if I'm correct, that it's coming, to have some bids in the type names you want to own on that pullback. And it's going to be scary to buy them when you do, and you may face, some drawdown, but you may very well be able to buy spiders, 5 to 8% lower than they are now. And names that are high beta type names, the quantum computing names, which are already up several 1,000% this year. We already saw last week how they could make mincemeat out of those quickly. gold, silver, GDX type names may see, a further hit, but I'd be buying those pullbacks at levels that you feel comfortable buying.
Rick, it's an interesting point about the potential for a short-term corrective move being a good buying opportunity, but then juxtaposed with the point you made about all of those funds sitting in money markets that could come into the market looking for a higher return and maybe fuel the next part of the cycle after that downturn. Just a quick question for you on the sea change we're seeing with financial institutions, at least some of them, shifting from the traditional 60-40, 60% equities, 40% bonds, to this new 60-20-20. And we haven't gotten you to weigh in on this yet. So 60% equities, 20% bonds, and 20% what they're calling alternative assets. So that could be gold or gold equities, but it could also be other vehicles and other instruments they're putting in that are kind of an interesting hedge. What do you make of the move there to kind of de-emphasize bonds, but also emphasize other alternative assets?
I think that the shift, which has started now for a few years, is still early in its change. I think a lot of financial advisors are reticent to make that type move. The average financial advisor is over the age of 55 in this country, so they're going to be more kind of old timers, and I'm in that category, so I'm not making fun of them. Just they're going to be more traditionally oriented, and it'll take a while for them to kind of shift that thought process. I think it's probably the right way of thinking of things. And I'm also longer term not a fan of owning bonds. Short term, sure. Could the 10-year get 3.5%, even lower? It can. Do I think down the road that any individual is going to want to lock in that type of rate over time? I don't think so. And other than the aging population, those who are, let's say, in their 60s and older, who do want to reduce some of the risk of owning stocks and therefore buy some bonds. Besides them, the younger crowd, if you're a 25-year-old, you know what Robinhood is, you know what Bitcoin is, you have no idea what a bond is, and you don't care what a bond is because it's not fun, it's not sexy, and you don't trade them. You take 2 years to make 10 cents in the bond market. It's just not a young person's, game to play. And I don't mean play as buy today, sell tomorrow, but just to own. And I think over time, we are not going anything close to what the low in the yields were from back in, 2020, when we got down to 40 bips or something like that for a US 10-year. So we're probably capped at I don't know, maybe I'd even say 2.5% best case scenario for bonds. But I think we've turned the corner. The 40-year bull market in bonds is over. So when we peaked in 1980 or 81 in yields, that 40-year bull market in bonds is over. So we could go sideways for years, but we're not going down to the lows, in my opinion. There's no reason to. And I think ultimately they're going to be a bad investment, as rates will head higher over time to more long-term equilibrium, which puts the US 10-year probably in the 6 to 8% neighborhood than the 4% that it is now.
What a change over the last few decades we could be in for, which trickles into a lot of different markets. We'll see how this all plays out. But Rick, you've given us some short-term trading strategies and also some long-term outlooks. So I really appreciate that. And thanks for, again, diving into more of the precious metals, how you're viewing those during this correction after what has been, I think we can call a pretty historic bull market run. Sounds like we still might be in for some more upside once we digest this current pullback. Again, Rick Bensignor, president of Bensignor Investment Strategies. Also, check out the In the No Trader website, which again I will link to in the show notes. That's where you can find all of Rick's retail and individual trading products. Rick, thank you so much for taking time with us on this weekend show. And everyone, thanks for tuning in this weekend. I hope you all have a great rest of your weekend. And please go back through our website, podcast, YouTube channel. Just search The KE Report. We're also on Substack. That's where you can find all our daily editorials covering market moves and company updates. Everyone, have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.